In this session we're going to look at my second major analysis technique, which is basically price spikes. This originally came from Peter Steidelmar's market profile, and I was introduced to this back in the 90s when I met an institutional trader, and he became a sort of mentor in fact to me for a while, and I found his approach to markets very enlightening. I think a sort of mentor type person is very important in the development of your trading skills, especially if you're going through the loss orientated phase, the fearful phase, where things can seem very confused and it's difficult perhaps to have total clarity during that phase. Steidelmar's idea was very simple. He took something called a bell curve, which I think was a Victorian. I'm not sure whether it's Victorian or not, but basically it was a way of analysing statistics. For example, people's heights is a good example of a bell curve. I mean, if you meet people at random, then their heights may seem extremely random. One person may be very short, next person very tall, and perhaps very tall again, and no obvious continuity between the different heights of people or ages or anything like this really. However, if you take a large number of people and you analyse those people, you'll find that most people are of an average height, and then you get very few people who are, say, 6'6", and at the extremes you get a much smaller number, and at the average you get a much larger number. The distribution curve that you're seeing on the screen at the moment illustrates this point. Now that could be people's heights. You see that in the middle there's a thick lump where most people lie, and then at the extremes there are far lower numbers. Now if you treat market action in the same way, and there's one big difference here. When we talk about time, we're not talking about the time of day. We're talking about the amount of time spent at a certain price. So as an example, let's say that FTSE is moving around the 6,000 level, and that 6,000 is the midpoint of the day, and that FTSE moves up to 60.50 and down to 59.50 during the day. But both those moves are sharp spikes. So such action would in fact fit that curve fairly well. The price here could be 6,000. Okay, so most of the day's action may have been like this, bouncing around that level, so that the highest volume would have been at 6,000 in that case. But during the course of the day, the market does blip up to here, and then it blips down to there, and what you get is a bell curve with very little action at these levels and lots of action at these levels. What Steidelmar then said was, well, I will say that value, and this is a way of defining value, lies where the most volume lies. This is a definition of value which bears no relation to PE ratios, dividends, earnings, all that kind of stuff. It's purely based on the trading during that day, and the value thus achieved may not bear any relation to what other people think of as value, but that's not really the point. The point is that having achieved that value calculation, then firstly you are led to say, well, if the price goes up above value, i.e. we see a spike here, I should sell, because at that point I'm selling above value. Similarly, if price is down here, I should be buying, because at that point price is below value. And certainly I have used this technique for some years, and you will find that the market does indeed trace out these bell curves. But I personally don't use that aspect very much. I use the spikes. It's the areas up here and here which I consider to be important. The reason I like price spikes is because it shows determined buying or selling. When I used to trade futures, I use price spikes almost exclusively for my trading, possibly allied to an Elliott wave pattern. So, for example, if we saw 5 waves up, the 5th wave terminated in a selling spike, then that would be a perfect signal. You have the Elliott 5 and then the selling spike, so you'd go short. The spike would allow you to place a close stop beyond the spike, and you enter at a point of your choice. You then have a low-risk trading opportunity. As I've said before, that's the key thing, low risk. I suppose that's what attracted me to binary bets in the first place, was the fact that everything you do with binary bets is low risk. The fact that's built in is such a huge advantage. Right, moving on to the next chart. These are all, by the way, extracts from the Binary Betting Bible, and you will be able to refer to this and read up on what I'm talking about. Right, here's the next chart. This one I think we discussed under Elliott to an extent, because I have marked in the Elliott wave. We've got the ABC coming down here, BC. Then we've got the price spike, which is here. So, you know, that spike was pretty critical for this whole move, really. 1, 2, 3, 4. You know, and you'll see as you look at charts that, you know, price spikes are fairly dominant things. They're all over the place. There's one here. I haven't even bothered to mark it. And that's a very nice spike. This one here is pretty trivial, although this is a half-hourly chart. The actual definition of a spike is a up to 3 price bars. Stoudemire calls these TPOs, time price opportunities. The terminology is not too critical, nor indeed. I mean, I think the 3 half-hour bars is quite a good one, but you should amend these things to suit yourself. You may prefer a different measure, and that's all part of making these techniques your own. You know, decide how you want to do it, and then choose that for yourself. So, you know, that's a good example of a spike showing us a good trading opportunity, which we did make money on, in fact. Now again, this chart here, well, you've got key spikes all over the place. Spike there, spike there. I mean, that one is a nice spike. You know, it's a particularly strong spike. This one here is a particularly strong spike. We then say failed retest. We're going to talk about failed retests in a little while. Falling away. But you know, if you look at a chart, you'll see that price spikes are pretty important, and often determine major moves. Also, if we just look at the spikes, it's very simple. Far more complicated if we look at the bell curves in the middle. I don't think it's such an important technique, but again, it's each to his own. I mean, I know traders who just use bell curves, and who do very well just using the bell curves. So it's a matter of choice what people use. Clearly, I'm telling you what I use, and that's all I can do, really. So we'll move on to the next chart here. The next chart is actually, in fact, based on a failed retest, but I'll make one quick point about a spike, and then we can finish this section. Ideally, what you want to see is, you know, spikes confirming your signals. So you may be using the Elliott pattern and ABC to pitch your trades. It may set you up for the trade, and then you look for a trading spike to actually position your trade. There are 2 distinct stages to trading. One is the setup, so you look for a setup. So the setup basically means that, right, I'm watching for this sort of signal, and then the actual signal itself can come in many forms. A price spike is one such form. Other forms are things like squared congestion, and in fact you could just use a simple bar penetration, i.e. you're looking at, say, a 5-minute bar chart. You have the setup in place, and a 5-minute bar low is taken out, so you then go short, for example, if you're going to go short. But there are these two distinct areas. Elliott actually is a better system for the setups. That's what it really does. It provides setups. Price spikes provide sell signals. It's when you have the two together that you can have a higher profit opportunity than if you only got one of those techniques in play. Right, thank you. That's the end of this session, and we'll get on to the next one in a short while. Thank you.